$10 a day. Not a salary increase. Not a tax refund. The cost of the lunch you didn't finish. The coffee you ordered out of habit, not thirst. The 2 or 3 small transactions your bank app logs every day that you scroll past without reading. I want to talk about what happens when one of those $10 goes somewhere intentional instead. Not because $10 a day makes you rich quickly. The math doesn't work that way, and anyone who tells you it does is selling something. But because the first $10 you invest consistently does something to the rest of your financial life that has almost nothing to do with the $10. It changes the category you're operating in. It changes what you notice, what you ask, what becomes possible. The $10 is not the point. What the $10 starts is the point. You open an account. Fidelity, Vanguard, Schwab, doesn't matter. It takes 20 minutes on a Tuesday evening. You link your checking account. You set up an automatic daily transfer of $10, or if your platform prefers monthly, $300 on the first. You select a total market index fund. VTI. SROX. SWTSX. Any of them. You confirm the purchase. Then you close the app. That's the entire action. 20 minutes. One decision. One automation. And the next morning you wake up and your life looks completely identical to the morning before. The coffee tastes the same. The commute takes the same time. The account has roughly $10 in it. The market moves slightly in some direction and nothing feels different. This is the part that causes most people to underestimate what just happened. Because what just happened was not a financial transaction. It was a category transfer. Before last night, you were someone who intended to invest someday. After last night, you are someone who invests. Those are not the same person. They make different decisions. They notice different things. They arrive at completely different places 20 years from now, not because of the $10, but because of the identity the $10 initiated. The behavioral research on this is consistent. The single most reliable predictor of continued investment behavior is having started. Not the amount. Not the return. Not the market conditions at the time of your first purchase. Whether the account exists and has money in it. You just crossed that threshold. Everything that follows is easier than what you just did. The transfer happens the way rent happens, automatically, without decision, without consideration of whether this is the month to do it. The identity shift that happened in month 1 is now so complete that stopping would feel like the anomaly. And something else has happened by year 10 that is harder to quantify than the balance. You have 10 years of evidence that you can do something consistently. That you can make a decision and honor it across market corrections, life changes, income disruptions, and every other force that typically erodes financial commitments. That evidence is worth more than the account balance in terms of what it predicts for the next 20 years. 2 decades. $72,000 contributed. Balance at 7% average annual return, approximately $156,000. The market generated $84,000 beyond your total contributions across 20 years. Your money has made more money than you put in. Read that again slowly. The account you opened on a Tuesday evening with $10 is now generating more wealth than you are. You are no longer the engine. You are the steward. And the person who opened that account 20 years ago, the one who couldn't quite picture what $10 a day could become, who almost talked themselves out of it because it felt too small to be serious, that person is genuinely unrecognizable from where you're standing now. 30 years. $108,000 contributed. $10 a day. Every day. Without interruption. Balance at 7% average annual return, approximately $363,000. The market generated $255,000. You generated $108,000. For every dollar you put in, the market put in $2.36. Your total return is 236% on your contributions. From $10 a day. From one decision made on a Tuesday evening that took 20 minutes and felt almost too small to matter. Now extend it. $20 a day for 30 years at 7%, approximately $726,000. $30 a day, approximately $1.1 million. The variable that matters most in all of these numbers is not the amount. It is the 30 years. The compounding needs time the way a fire needs oxygen. It doesn't work without it. And more of it produces results that scale faster than the input suggests they should. The person who starts at 25 with $10 a day arrives at 55 in a fundamentally different financial position than the person who starts at 35 with $30 a day. Even though the second person contributed more money. The decade costs more than the contribution. The market drops. Not catastrophically. 8, maybe 10% over 3 weeks. Your roughly $1,800 in contributions is now showing a balance somewhere around $1,650. You have lost approximately $150 on paper. And your nervous system, which evolved in an environment where loss meant something physically dangerous, registers this with a response that is completely disproportionate to what actually happened. This is the first test. Not of your financial sophistication. Of your ability to do nothing when doing nothing feels wrong. The people who pass this test, who look at the 1650 balance, remind themselves they don't need this money for 30 years, and close the app without touching anything. These are the people who build real wealth. Not because they're smarter. Because they've correctly understood that their job at this stage is not to optimize. It's to not interfere. The people who fail this test move to cash. They wait for the right signal to get back in. The signal never arrives clearly. The market recovers while they're waiting. They buy back in higher than they sold. J.P. Morgan tracked this. Missing just the 10 best trading days between 2003 and 2023 cut total returns in half. Most of those 10 days happened within 2 weeks of the worst days. The people sitting in cash waiting for stability missed the recovery that began while the news still looked terrible. Your balance dropped. You closed the app. You did nothing. That was the right answer. 12 months. $300 a month. $3,600 contributed. At a 7% average annual return, your balance is approximately $3,740. You made roughly $140 beyond your contributions. $140. The return on a full year of disciplined daily investing. From the outside, this looks like an argument against starting small. From the inside, it is evidence of something the early years never show clearly but the later years prove completely. You are not building a balance. You are building a rate. The $140 this year becomes $280 next year on the same contributions, because the base is larger. The year after that, it becomes over $400. The compounding is not dramatic yet. It won't be dramatic for several years. But it is present, and it is accelerating. And every month you continue is a month that acceleration has more base to work from. And there is something else happening that doesn't show in the account balance at all. You've started noticing things you didn't notice before. The expense ratio on the fund inside your 401k, the one that charges 1.2% when a comparable option charges 0.03%. The credit card interest rate that is effectively canceling your investment return every month you carry a balance. The account balance changes. That's the obvious answer. But what changes first, in month 1, before the balance is meaningful, is the relationship with money. The $10 investment creates a financial identity that expands. You start asking about expense ratios because you have an account with expense ratios. You start understanding compound interest because you have an account that demonstrates it in real time with your real money. You start seeing your credit card balance differently because you can now calculate what it's costing you relative to what the investment is producing. The $10 a day is a financial education that pays you to attend it. Every month the account exists, you learn something about how money actually works that no amount of content consumption produces as reliably as having real money in a real account doing real things. And the other thing that changes is harder to name. It's the 2 a.m. phone check. Not immediately. The early years don't provide enough balance to quiet that anxiety. But somewhere around year 5, the check shifts in character. It's no longer panic-driven. It's curiosity.